I think that I think we have kind of forecast with the sector research and the things we've been talking about the last few months that, investors have started to position for a maturing of economic growth, right? And as a result, if you're maturing and inflation is heating up, then that's likely to prompt the Fed to try and tap the brakes at some point to slow things down and kind of contain inflation. Obviously not there yet, but this week the FOMC, the Federal Open Market Committee, got together, and I think they gave the most hawkish shift in their conversation so far. I mean, they absolutely, looking at that, coming out of that meeting, thinking to myself, oh, well, you know what? I think they could be behind the curve here again. I mean, it's hard to say. You won't know until retrospect. But I mean, historically, Joe, in my experience, the Fed, it oftentimes is overly optimistic on how long they can wait to raise rates. And as a result, they end up, continually pulling forward their estimate, and then they have to get more aggressive. So instead of so right now, Joe, they think 2023 would be the first hikes. So 2 in 2023. Previously, they were, modeling for 2024, right? I think now it could be one of those things where it would not shock me if we end up getting a hike in 2022, especially if inflation continues to run as hot as it is right now.
Yeah, and what was they revised the inflation projection for the year, right? Is it 3% now?
Yeah, I think if you're including food and energy, which are really volatile and bounce around a lot, and a lot of people like to say, oh, X energy and X food. Well, I don't know about you, Joe, but I drive my car and I heat my home. So, energy is an expense I have to pay regardless if it's volatile.
And we all eat food.
and right, Joe, we don't eat grass. So
that's right. Yeah, so, unfortunately, our backyards are only so big. We don't have an industrial grade farm in our backyards. So yeah, I would say those things are pretty important.
Yeah. So, I mean, now they think that, gross domestic product, which obviously economic activity increases and, price of goods increases alongside demand. So they increased their GDP forecast to 7% for the year. I think that was up from 6.5.
6.5, I believe. Yeah.
Yeah. And then I think they took their inflation projection up almost a full percentage point to 3%. So, I mean, and that's only since March. So, I mean, like the last 3 months, all of a sudden they're like, whoa, wait a minute, and it would not shock me. I mean, if, like I said, if this is the first of what will be many accelerations in their timeline, and much more of a hawkish approach. And if that's true, if that's the case, then I think that we're going to see continued movement from investors as they rotate away from, originally we were talking about they were rotating from early cycle to mid business cycle type stocks. So they were embracing some of the, inflation oriented baskets. And then, theoretically now, if the Fed is behind, if we are going to get more inflationary risk, then I think, the market being a leading indicator, discounting mechanism looking ahead 6 months, 12 months, that we're going to start to see some of these baskets that are inelastic to economic activity, like healthcare and utilities, start to climb. I mean, I think one of my biggest takeaways, Joe, coming out of this was that I probably need to get more healthcare stocks in my portfolio.
Yeah, I think that's a wise move, and that's a good segue to kind of talk about how investors, how our viewers and listeners should be reacting to the news. I mean, obviously we say not to be very kind of knee-jerk reactionary, right? You don't want to be the one who's buying the rumor and selling the news. You want to be more principled than that. But still, as you said, this might be a good time to start to think about pivoting into some other baskets. So what's kind of your high level approach to that, Todd?
Yeah, I mean, so it's funny. We were just having a great Twitter conversation. If you want to follow me on Twitter, I'm at EB Capital for those of you who are listening or watching. Yeah, we'll link it below in the show notes. And we were just having a fascinating discussion about that. Is can you beat the market, and how the heck can you beat the market over time? And I think that you're right. You don't. In 25-year career doing this full time, I can't put my finger on somebody who has made it as a day trader or someone who consistently uses margin. So I avoid those things, So I think you're better off approaching it as if you're trying to turn a freighter rather than a speedboat, in my view. So I mean, you're making these changes on the margin in your allocation. So Joe, I'm a growth investor, so I'm going to naturally have a lot of technology stocks in my portfolio. It's just the way it's going to be.
Yep.
But on the margin, I can start to embrace some of these other baskets and kind of insulate myself maybe a little bit against the volatility that could be, rising as the market gets a little bit more tough to navigate. So, doing my pivot earlier in the year where I was buying more energy stocks, and now as I'm talking to you now, starting to think about, okay, as things rotate out of my portfolio, maybe if I have a watch list that's made up of 50 stocks, maybe I put a little bit more weight on those stocks in that watch list that happen to fall within, say, the healthcare area rather than the technology area, recognizing that I'm already pretty heavily exposed to technology as it is. So I think the long answer to that, Joe, is just, again, trying to, on the margins, get your sector allocation right? Look for baskets that are likely to benefit in the coming quarters. And then obviously, have your core portfolio where you're not turning around. Like one stock that I've talked about on the show a lot is NVIDIA,
Yep.
NVDA, and we highlighted a couple different times in our smatterings. And just as an example of, if I have a winner and I've entered it right, I will ride that winner. It just joined my 600% club. So I'm now up about 600, yay, 630.
Congratulations.
Yeah, thank you. On that one particular name. So I'm not talking about, press sell, and just buy, and be chasing your tail around the room. What I'm saying is that on the margins, as you're making changes to the portfolio, do so being cognizant of where you may be overweighted and underweighted relative to where you think the market may be heading, or that whole great skating to the puck analogy.
Yeah, absolutely. And side note, for those of you who do own NVIDIA stock, congratulations. It has been one heck of a week. I'm definitely suffering from a bit of FOMO. And personally, I'll have to wait for it to pull back a little bit for me to be comfortable kind of entering in. It's been on somewhat of a vertical trajectory this week. But yeah, fun to watch. And I know there are a lot of happy growth investors out there. So just to kind of wrap this up, Todd, you and I, obviously we've talked about it many times. We have our forever stocks that we're holding for at least several years. And so those are kind of, etched in stone, if you will. They're not gonna change anytime soon. So then the rest of the portfolio is what we're kind of cycling in and out of. And so just to give people a general idea, I believe you said either on Twitter or Discord this week that you had gotten your cash position up to like 5-ish% now.
Yeah, I was fully invested up until I think last Friday, and I started to take some things off and just selectively pruning some of the things in my portfolio. There were a few stocks that had run up pretty big in a short period of time. I pocketed those, trimmed a couple other areas, still like the company, but I believe that if you've had a big run, you're likely to digest it and pull back. And I'm always looking to try and, manage that on the edges, not wholesale buying and selling things, but when you see certain opportunities, taking advantage of them. And as a result, before the Fed announcement, I got myself up to about 5% cash because there was just enough uncertainty from my view into what was going to be said that I felt like it could cause some surprises and some weird action. And sure enough, we did. We got some weird action. I didn't spend any of the cash. I decided I was just going to sit on this and let it shake out a little bit. I want to see how this goes. There's a tug of war, it seems like right now, Joe. You've got on the very first day following, you had this big run up at technology stocks. And to me, that was almost like these highly speculative people saying, oh, they're not going to raise rates until late 2023. There's still plenty of time before they pull the punch bowl. I can go out and get back into my speculative names. So you had that camp. And then you had the other camp of people who maybe owned a lot of commodities and energy stocks who said, oh, whoa, no, they are raising rates, in as early as 2023. And I think it could be earlier than that, 2022. So we got to start getting out of some of these mid-cycle inflationary stocks. So they sold those off. And then you had the late cycle people going, yeah, if it's really going to slow down, then I got to bid up some of these healthcare stocks. So it was it's very noisy week right now.
Yeah.
So I'm trying to step back and look at it from the 10,000 foot view and say, okay, I'm not going to get caught up in the noise. What do I really think is going to happen from here? And I do think that the business cycle trade is intact, meaning that we're going to have multiple quarters still of greater than expected growth and profitability for things like energy. So I'm not selling my oil stocks yet. I'm going to let this play out a little bit further, see how these stocks act in the next couple of weeks. Like I said, I do want to try and position a little bit more into healthcare. And of course, like I said, I'm a growth investor, so I do have a lot of technology and a lot of those fall into that forever mindset. So I'm just going to pretty much keep there, but also just be trimming the edges to try and do these other things too.
I'm going to go ahead and go out on a limb here and guess that your smattering is going to have at least a few healthcare stocks in it this week.
Well, you'll be surprised. You'll be surprised actually, because that was my intent. When I started looking through all of our best and worst free link to a free trial below, when I started looking through our best and worst large, mid, and small cap, I was like, oh yeah, I definitely want to make sure that I'm getting some good healthcare ideas to put in there. And what was interesting, Joe, is that healthcare in our sector ranking had been at the bottom for months. And in the large cap, not in mid cap or small cap yet, but large cap is oftentimes tips the hand. Because they're liquid. Institutions, if they start to reallocate, will first go to those liquid large caps. So healthcare now is like one of the top sectors. Over the course of the last 3 weeks, it's climbed.
Yeah,
up.
it's been inching upwards. I've noticed in the weekly reports.
Right, and then I was looking through the charts, and I'm like, you know how much I like big volume and certain setups and everything, and I'm like, I can't find a lot of setups I love enough to talk about in the smattering. But generally, my takeaway after looking at the healthcare was, yeah, they're under accumulation, but I couldn't find any that really fit my my specific criteria for highlighting the smattering. So I think for listeners, it's like, okay, you're saying focus on healthcare, but I don't think you need to like go out tomorrow and buy these things. I think that we will get good setups. So tune in every week. And I'm going to try and highlight these things for you as they start to come into that perfect combination of stuff I like to look for.
That's right. Like, comment, and subscribe so you don't miss anything. So yeah, YouTube viewers, we're gonna leave you with a bit of a teaser there, and we'll have the smattering in a separate video. Listeners, you're lucky enough that you get this uninterrupted. So what do you say?